Uh, what a couple of weeks it's been in the world. It's pretty amazing. As you know, I do a lot of reading, but I have not been able to keep up with the news, whether it's news out of the UK with their new prime minister, whether it's news out of China with President Xi and his new team and the party Congress and US Saudi relations going further south, the war continuing in the Ukraine. Europe getting better, getting worse, depending on the day in terms of their energy problems, and the rest of the world struggling with slow growth and high inflation. So pretty pretty challenging setup there. So I want to cover three things today. What's changed over the last year, both positive and negative. Talk about the switch from QE to QT, which there is no precedent for, and I think we're have to be careful not being too complacent about how big a change this actually is, and then give a sense of what the bears are saying, the bulls are saying, and what we think is happening, which is somewhere in between. So when I think about what's going on, really, all assets are going through a revaluation process, which is a reflection of the regime change on monetary and fiscal policy, as well as the inflation expectations that have hit and the slowing growth. The Fed now is really focused on inflation at the cost of higher unemployment, which could be a pretty significant shift in the unemployment to get inflation back down, which could be a 1% change. Pretty big, significant impact on a lot of people if that happens. And you're already starting to see even the areas that have had the most success over the last couple of years are starting to rein in their hiring. Amazon just announced slowing hiring in the cloud business, which we think is still in the middle innings of opportunity there. So there is some big changes going on the employment side. I think the biggest issue we're dealing with right now is investing without the safety net we've had for the last 12 years. Going back to 2009 when Bernanke really launched QE1, we've been having the Fed puts supporting the markets and then intermittently fiscal policy really giving some juice to the system. And now we're going back to fundamentals mattering, really matter again. And we really should be focused on really getting back to the type of investing we did before all the central bank gyrations. We still like the US best. We're not saying it's in great shape, but it's in better shape than most. And when you want to figure out where to put capital to work today, we say follow the money, whether it's in the reshoring, Didi was just talking about the use of robotics and other areas. You can see where spend's going. The defense industry attracting a lot of capital. Advanced tech obviously is one of the big pushes, and governments told you on infrastructure they're going to be putting money out. And even in the semis and the reshoring and stuff, we see a lot of opportunities there. And I think that's where, if you want to invest right now, go where the money's going to be moving, and the governments are telling you where that is. So let's look at what happened over the last year. Going into a year ago, we were really thinking about deflation and fighting that. Inflation was really not high on the radar. It was a problem, but really not what people's expectations were. And I think that's because for a decade or so following QE1, everyone was expecting big inflation coming, and it didn't come yet. I think it came when we layered on a much stronger economy with a lot of fiscal policy that was overwhelming. And I think that's what's created the inflation problem. But that is a big change. We're now in an inflation fighting mode. You've seen it in commodity prices, which were flat for a good chunk of last year and now moving up. Monetary and fiscal policy reversals are major to me. I think the strong dollar, which was level for a good part of last year and now has really taken off. But on the other side, you see prices coming down, whether it's used in new cars, the Baltic freight has really come down. We're starting to see rents coming down. And I think there's a calculation issue that's distorting the housing problem, in that the way they calculate it, they don't factor in the fact that people are in much better shape on their housing mortgages and housing equity than they were before. So I think the calculation's probably not as reflective of what's really going on. But if you look at it, we were last year growing at 6%. This year we'll be growing at about 3, going down again next year. So I think that's a big change. You had a rapid move up because of all the stimulus, now to a much slower economy. You had inflation expectations starting to take off. Now they're starting to come back down again, but people have no belief that they are really coming down yet. So this is the 5-year forward expectations for it. And 2.4 seems a little low. Whether you get there in 5 years or not, there's a lot of factors that would come before we can get to that. But here's the commodity price change. And now you're starting to see it really shift down. And when I look at where we were in January of 21 down at this level, and then really skyrocketing up and then coming back down, we think you'll see more of that coming down. But a big swinging factor in that is what happens with China, and do they end the lockdowns and really get their economy back on track or not? I think that's a big wild card in the system. The other big change is the dollar, and you can see where this has been for the last year and how that's spiked up. I think we're probably closer to the end of the dollar spike move, which would be good for a lot of the multinationals and good for the global economy if we're not having that strong pressure. But you could also make the case that the US is still going to attract a lot of capital, and that's going to create some more strains on the system. But I suspect we're getting towards the end of this short-term, that is near-term move up in the dollar, and we may be seeing a little bit of reversion, particularly as the ECB starts to get more aggressive in rates. And if the Fed expectations for the Fed rate hikes start to slow, I think that'll be a positive in moderating the dollar. But the dollar moves have been massive this year and really disruptive. I think you're starting to see with reshoring and other stuff, manufacturing going through some changes. This is the PPI for manufacturing showing some prices coming down. I think some of that has to do with the supply chains easing. And just to give you a sense, a year ago, there were about 106 ships waiting to unload in the Port of LA, Port of Long Beach. That's now down to 4 ships. That's a major change in easing the supply chains. And you're starting to see that with retail pricing, where retail inventories are high. They're starting to discount in the retailers. So you are seeing some of the inflationary pressures that were supply chain driven come off. I think the China to the US, the Asia to the US, and to North America supply chains are healing and close to healed. I think it's the war that's really pushing the inflationary pressures up, but creating some input costs that still remain high. But we expect that you'll see some easing in the pressures industry by industry. This just looks at used car prices, and I expect they're going to start to really see it turn down even more pronounced. There's used cars and trucks. Housing affordability is one of the big issues facing the US, and this is the 30-year fixed rate mortgage, not the jumbo. This is showing going from below 2% now up close to 7%, which on an average house in the US is adding about $300,000 to the cost of the mortgage over time. So big change there and a big difference in where we are. So that brings me to the other change that I think is really weighing on the markets, and the switch from QE to QT, which we don't really understand because we've never seen something on the scale that we have here. This is the 10-year Treasury, and you can just see how much that's moved up as we're starting to move back to a bit of a normalization of rates. Whether they can sustain at 4.5% or not is another issue. I just saw today that the net interest for the US is projected to be $435 billion this year, which would be higher than what we spend on vets and food and nutrition in the US from the government. It's projected to move up and over the next couple of years exceed the defense spend. So I think we're going to have this normalization process. The question is, what level can we sustain on rates? We've sustained at this level before with the right growth, but we have to get inflation under control. I think the other issue, and this is the German 10-year main, and you can see that we went from negative rates to positive rates there. That is generally a positive for the German economy, but for the bondholders, not so much so. And I think that really is this transition of negative interest rates to normal interest rates. We're going through the painful process that includes. And here's a look at the central bank assets. This is the red line is the Fed assets increasing. and the blue line is the Euro area central bank, the ECB. And you can see after a big move up, they're starting to roll over again. And that's with the US pulling back. And we're projected to reverse. We're doing about 90 billion a month right now coming off when we were adding 125. So think about that, $250 million switch a month in terms of liquidity, which I think is actually creating some disruptions and some problems in the markets today. So what are the bulls saying and what are the bears saying? So the bear case is policy reversal is going to cause a recession. Fed's going to go too far, get too tight. Central banks around the world will experience the same thing. We'll create a recession by being too aggressive in the policy changes when the economy can't afford it. It's creating that recession then will depress valuations and earnings even further. And this is where you have the guys coming out saying there's another 15 to 30% to go there. If you get the bear case, you'll see bubbles continuing to burst everywhere, and that'll accelerate at a pretty rapid rate if we go into the real bear case. And once again, the most vulnerable will be hurt the worst from that. And that's the most vulnerable countries, companies, and individuals. And this will create massive collateral damage to the global economy and the financial markets. And that's what the bear case is saying. I think the bull case is that we are starting to see a moderation of inflation and that the recession in the US could be avoided, which will soften the global recession. Whether we avoid a global recession or not, I think is highly suspect, but it's the degrees that you'll get there. Central banks won't have to tighten as much as or for as long, and that's really what you're hearing out of the Fed lately, that they will tighten, but they're not going to go quite as far as the market thinks. But I suspect they're going to stay at the levels longer than the market's expecting before they have to change. I don't see them really easing as much as everyone would think. It would take a real problem. And if we have that, then you probably would have had the bear case going through first. I would argue that a lot of bubbles are bursting, and you're starting to see that in different areas. And Ed Yardeni his research right now is focusing on, we're in a series of rolling recessions, which will make the ultimate recession less bad. I can see that argument pretty clearly. You've seen it in different areas of the market that we're running at multiple speeds, and whether the retailers now are dealing with inventories that are excessive, you're going to see them hit in different pockets. And I think that's one of the other issues. But if you believe that central banks won't be tightening and that inflation will moderate, then earnings and multiples will start to slow their declines, and you'll get footing in the market, and that'll allow us to move back forward. And during this, the US will continue to benefit from its safe haven status by attracting a lot of capital back in. And I think our US companies will be viewed, particularly the big ones, in a different light with what's going on in China and their corporate champions. I think there's a question of where do you go for governments and companies where you can feel a higher level of confidence in where you're investing. So our view is somewhat in between. We think that the world is going to go into recession. We think the US, it's 50-50 whether we go into a recession or not, or how deep it is. We're not expecting a deep one here unless we really blow stuff up around the rest of the world. I think rates are in the peaking mode and will start to come down. And I think inflation is starting to come under control. I do worry a lot of the inflation issues will depend on policies, and the policymakers seem desperate right now, and that leads to bad decisions. So I think we have to keep that in the back of our mind. You saw what happens when you have too radical a change in terms of policy with the UK leadership over the last couple of weeks. So I think it's going to be very hard for them to move too dramatically in either direction. So we think you're going to be more in the middle, that there's not a real bull case. There is a bear case, but it's not necessarily as bad as the bears are making it out to be, because we think we're further along in the process. I think the other thing that's really screwing people up with this is understanding how stimulus works on a delayed basis. And we're really seeing the amount of massive stimulus done last year still pushing them through the markets this year, which is why companies and even countries are doing better than people would have expected. I think it's just a reflection of how much the change goes through and how long a lead time it has. On the other side, when we hit the bottom here and are really going through, a lot of the things that the governments have been putting in place today to be restrictive will then be restrictive for another year to a year and a half. So we're going to be fighting headwinds for some time. So it makes it much more time to be much more selective in the market. So clearly a mixed case. We're coming out of it on a little bit more positive view than the markets have, but there's so many uncertainties, whether it's what does Xi do with China now that he's got his party where he wants it to be, and how can he get back on a growth trajectory without really creating big problems for his economy. Big question with Russia and how far do they go in terms of the war? Will we acquiesce? And you're starting to see the progressives in the US are suggesting that we start negotiating with Putin. I think that's a bad sign when you start to see Western countries really weakening on their resolve to manage the war in Ukraine and really support Ukraine. Because I think if you give Putin an inch in Ukraine, he's going to take it elsewhere. So I think this is really one of those big deciding factors for government leaders around the world. How are they going to face off to the adversaries when economics versus real public policy and the geopolitics align? So I suspect we're going to be in a bouncy period through the rest of this year, but with a bias up in the markets in the US in the near term. But then we're going to have to see where things shake out. We like to invest in the areas we know capital has to flow, and that is in this electrification process, digitalization, national security, biotech, and special situations. So, Mark, I'm going to stop there and open up for discussion.
Okay. Thank you, Stephen. Questions, comments, positions?
I'll ask a question if that's okay, Mark.
Yep.
So Stephen, can I ask you a little bit about the telecom sector
Yeah.
and China? We saw Huawei selling off their cell phone as a segment unit. Any sense on China-US relations, telecom overall? Thanks.
Yeah, I think it's going to get worse before it gets better with China-US, unfortunately. And I think that's bad for the global economy. I think we need to get back. We have a bad relationship with them right now. We obviously have a bad one with the Saudis, and we have to get those relationships back on track to not where we're acquiescing, but where we're working together in a meaningful way. But I think the war on advanced technology is going to make that very difficult. So I don't see us really moving together. I think this is really the setup for a bifurcated world where you have the autocratic nations against the democratic nations, or whatever their version of either of those is. So I think the Chinese would view the definition of democracy in the US a little loose, and we would view their definition of autocracy a little different than they would. But I think we have to get to, we're not going to get there very quickly. And I fear that we're going through this global divide right now that will make it more expensive in the near term, but more secure in the long term. So I think it's a tough area right now. But you're really redoing all your supply chains to all your infrastructure around that, and that's going to be tough.
Stephen, can we get to a point where, I mean, it seems like both sides have decided to pursue that, and so just the process of that has been a conflict itself.
Yeah.
Can you see a situation where everybody just agrees this is what we're doing, but we can still communicate, and then things settle down a little bit? Is there a scenario like that out there?
I'm sure there is, but one of the challenges with the telecom area is there's also a fight for who's creating the 6G and the next evolution of the internet. And is it going to be a Western version, or is it going to be more of a Chinese version? And how does that play out? So there's really big stakes here, Duncan, that are at play here. And I think it's much more complicated than just the governments agreeing to agree. I think there's long-term economic and strategic issues at play here that are going to make it very difficult.
Stephen, on special sits being sort of just a general category, are you thinking about anything in particular, or are you just talking about essentially 2022 bubbles bursting, interest rate changes,
Very specific. I'll give you a good example. Charter, which has gotten sliced from, Charter Communications got sliced from almost $900 down to $370, something like that today. They were doing it. They had a big announced buyback at 900. They do the same buyback at 300 or 350, 380, whatever. You're going to buy back twice as many shares for the same dollars. So we're looking at those situations where a company, even in a tough area, can financially engineer their way significantly. They're one name that's doing that. We have 4 in our flagship 30 stock portfolio that are having massive buybacks that with this downturn in price, they're still having the cash flows that they're able to really ramp that up. So, Charter could be pulling in 30 to 50% of its company over the next couple of years in share count. And, so that's what we would be focusing on is special sitch. We don't love the communications sector right now per se because of the other challenges they're faced with, but that would be an example. And there's others, Electronics and others are in the same boat.
And Stephen, on the flip side, so you have the cash rich and the cash poor. On the cash poor side, going not so long ago, you kind of refinance virtually anything, and that's obviously changed. The ultimate upshot of that isn't clear, at least to me. If you have any views.
Well, it goes back to my view. There's a have-nots stock market right now, and there are a number of companies that just, no matter what they do, can't get past because their business is slowing and their debts are so heavy that they can't get out of it. So I think you're going to see a lot of the highly indebted exposed, which leads to another area that is a concern for the overall economy, which is the switch from shadow banking or non-bank debt versus the bank debt in the system. In 2000, it was almost even with around 51 trillion in each. And today, I think the non-bank debt is significantly higher. And I think when those bubbles burst, we're going to find out there is a lot of danger in the system that isn't clear. I think in the US case, the US banks are going to be really well positioned for that. But I think that's going to create some problems when the debt comes due on the non-bank debt. And we see who's actually holding and who's holding it and what the problems are with that.
Well, it's already started that a whole bunch of high yield issuances this year had to be sold at discounts to the expected prices, and not only weren't oversubscribed, they were undersubscribed. But that's more anecdotal than scientific.
And I'm getting the hook. So is there any other questions?
No. So did you guys just see that? There was no hook. He's hooking himself.
There is one more question, which I saw Adam had his hand raised. So if you're okay, Mark, we can answer that one. Hopefully.
I'm okay. Are you okay?
I'm okay.
You're hooking yourself.
I saw the Ukraine update. I'm anxious to hear what they have to say.
We'll get there. We got a couple minutes. Go ahead.
Adam?
Steve, thank you for avoiding that hook. I did see it.
No. All right.
Hey, Stephen, it's Pete. Just a question for you, maybe a few comments and then a question. I agree with, again, background. I'm a partner in a law firm that I do IP and patents, but I do a lot of deal flow and see capital flow, and it's become something of a passion of mine. And with all the concerns, I still see the market almost at 32,000, and I still see capital flow, obviously much different than the dire circumstances of 2008. We recently had one smaller deals, but one company got 3 million, another company got 6 million, 6.5 million. Company today getting 10 million. So there's still a lot of deal flow going on. I guess my concern with everything you're saying about the bifurcated world in China and Saudi Arabia is the companies with big positions in China, namely Nike, Apple, Tesla, and many others. But my question goes back to UK.
You have 30 seconds. Keep going.
Okay. Hey, leadership. Have you studied the background of the new leader? Is there is it finance background? What's your expectations or hopes, shall I say, after that 6-week debacle?
Well, we have a history. He's a former Goldman guy, so another Goldman guy in government. He's also, I think he's worth about 800 million, so he would be an unusual leader in that respect, although in Congress he would have had that easy to make that money trading ahead of everything. But I think he's got a big problem with a bad bad hand he's playing. So I don't know how they get past some of their issues, because I think they go back a lot longer. I think goes back to pre-Brexit, that some of the issues in the UK. So I think it's going to be tough for whoever's in there to get them out of it, unfortunately.
Adam, I know you had a question, but I think you're gonna
Sure.
weigh, but you're gonna
Sure.
weigh in on this next segment. So just before we switch over to Ukraine, which is your
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.